Hi everyone! Right now, while 90% of investors are gambling on stocks, trading at 28 to 70 times earnings, a quiet group is collecting 3.8% dividends and building compound wealth. They're playing a completely different game. By the end of this video, you'll understand exactly why the top 10%, who own 67% of all wealth, are chasing Nvidia. They're doing something smarter, something most people will never discover until it's too late. The Buffett Indicator just hit over 220% of GDP. That's 68% higher than the historical average. Translation: the market is priced like it's living in a fantasy world. The Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla, now control 1/3 of the entire S&P 500. 7 companies representing 33% of America's 500 largest businesses. Nvidia trades at a forward PE of 28 times earnings. Tesla commands a premium 60% higher than the entire tech index. These aren't investments. They're bets that irrationality will continue forever. But while growth chasers pay astronomical multiples, SCHD investors collect 3.8% dividend yields on quality companies at reasonable valuations. They're getting paid to wait while building real wealth through cash flow, not paper gains that vanish when bubbles pop. Let me break down the wealth trap catching 90% of investors. Problem number 1, valuation insanity. Morningstar shows the market trading at 102% of fair value. Only 20% of the time since 2010 has it been this expensive. Growth stocks trade at a 14% premium, approaching dot-com bubble levels. Over 90% of professional fund managers believe U.S. stocks are overvalued. Yet they keep buying because managing billions leaves no choice but to stay in the game. When you control that much capital, sitting in cash isn't an option. And if you're buying S&P 500 index funds thinking you're diversified, you're actually making a 33% concentrated bet on 7 tech companies. That's not diversification. That's hope disguised as strategy. Most investors won't realize this until the correction hits, and 30% of their retirement vanishes overnight. The solution? Value stocks trade at a 3% discount right now. SCHD tracks the Dow Jones U.S. Dividend 100 Index, focusing on quality dividend payers with at least 10 consecutive years of payments, strong balance sheets, and actual profits. Not promises, not hype. Real earnings from real businesses. Problem number 2, concentration risk strangling long-term growth. The Magnificent Seven account for over half the S&P 500's gains. When they correct, and they will, your diversified fund crashes with them. In 2022, all 7 fell double digits. Every bubble meets reality eventually. SCHD holds 100 high-quality dividend stocks across multiple sectors with zero exposure to overvalued tech giants. The fund automatically removes underperformers and adds stronger dividend growers. Bristol-Myers Squibb and Cincinnati Financial recently replaced Merck and 3M, maintaining 11% dividend growth at reasonable valuations. It's a self-cleansing process, keeping quality high and prices sensible. Allocation strategies that work. Conservative investors take 60% SCHD, 30% bonds, 10% cash for current yield, around 3.8% with downside protection. Moderate investors use 70% SCHD, 20% value stocks, 10% growth for balanced exposure. Aggressive investors run 50% SCHD, 30% individual dividend stocks, 20% strategic growth positions for maximum upside while maintaining income. The dividend reinvestment snowball transforms everything. Invest $10,000 today plus $100 monthly using SCHD's historical 7.67% annual price appreciation and 11.54% dividend growth with reinvestment. You'll reach $51,237 in 10 years. After 20 years, $239,621. That's a 605% total return. Without reinvestment, only $132,000. The difference is $107,000, or 81% higher returns, just from automatic reinvestment. That's the power of compounding most investors never harness. By year 13, total dividends equal your original investment. By year 17, annual dividends match your initial $10,000. By year 25, you're receiving 115% of your invested capital every single year in dividends alone. This is how generational wealth gets built. The wealthy build fortunes this way, not chasing the next hot stock, but collecting cash flow from quality businesses that pay regardless of market conditions. It's not exciting, it's not glamorous, but it works. Problem number 3, the timing trap destroys more capital than crashes. Growth investors believe they can exit before bubbles pop. When Nvidia briefly became the world's most valuable company, retail piled in at the top. When Tesla surged, they bought the peak. Always buying hope, always selling fear, always losing. SCHD investors don't time anything. They buy quality at reasonable prices and collect cash flow. When markets crash, dividend checks continue arriving. When markets rally, they capture both price appreciation and growing dividends. The result? 12.92% annualized returns since inception. No timing required, no stress included. Your 3-month escape plan. Month 1, calculate your Magnificent 7 exposure. S&P 500 index funds mean 30 to 35% concentration in 7 stocks. Open a brokerage account if you don't have one. Start with $1,000 to $5,000 in SCHD. Enable automatic dividend reinvestment immediately. The compounding only works if you reinvest every payment. Month 2, increase your position every paycheck. Set up automatic monthly investments of $100 to $500 or whatever fits your budget. Consistency beats size every time. Verify your emergency fund covers 3 to 6 months of expenses before aggressive investing. SCHD can't help you if you're forced to sell during a crash to pay rent. Month 3, develop target allocations based on your age and risk tolerance. Under 40, consider 50% SCHD, 30% growth, 20% bonds. Age 40 to 55, shift to 60% SCHD, 20% growth, 20% bonds. Over 55, go 70% SCHD, 10% growth, 20% bonds, and cash. Rebalance quarterly, never daily. Let the strategy work without constant interference. The Federal Reserve's quantitative easing inflated this bubble. Printing trillions sent money straight to asset prices, not the real economy. The rich got richer, owning assets, while the middle class got squeezed by inflation eating their wages. The wealthiest families own 36 times more than middle-class families in 1963. By 2022, 71 times more. The gap exists because the wealthy understand this truth. Cash flow beats capital gains. Dividends beat speculation. Quality beats hype. Patience beats panic. SCHD gives regular investors access to the same playbook. Quality businesses, consistent dividends, reasonable valuations, automatic reinvestment, compound growth. It won't create overnight riches, but it builds real fortunes while growth chasers ride the emotional roller coaster. Valuations are stretched, concentration is dangerous. The next correction is coming. Nobody knows when, but everyone knows it's inevitable. Will you be positioned to survive it or become another statistic? SCHD investors sleep through corrections because dividend checks never stop. Portfolios might drop 15 to 20%, but cash flow stays steady. Then, during recovery, they've been buying the dip with reinvested dividends the entire way down. This is the wealth game the top 10% play. They don't chase growth, they collect income. They don't time anything, they own assets that pay regardless. They don't speculate on trends. They invest in businesses with sustainable competitive advantages and proven track records. With SCHD 0.06% expense ratio, you pay just 6% annually per $10,000 invested. That's essentially free compared to actively managed funds charging 1% or more. Over 20 years, these low fees save thousands and maximize compounding. You can keep chasing the Magnificent 7, hoping you're smart enough to exit before everyone else, or start playing the game the wealthy play. Build quality dividend growers. Reinvest every payment. Let compound interest work its magic over decades. 10 years from now, you'll either wish you started today or be grateful you did. Markets might stay overvalued, growth stocks might stay in bubbles, but quality dividend payers will keep making money, paying shareholders and growing. That's the real wealth game. SCHD is your entry ticket. If this opened your eyes, hit subscribe now. Drop a comment with your current SCHD position or target allocation. The wealth gap widens every single day. Which side will you be on in 10 years? Remember, I'm not a financial advisor. This is educational content only. Your investment decisions are your responsibility, and results depend entirely on your actions and market conditions. Smash that like button, share it with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.